Welcome back to another stock review. Today's company is one I'm sure you're all familiar with. It's Disney, ticker symbol DIS, which is in the movie and entertainment industry with a market cap of just under $152 billion. As always, we're going to hop over to the company's website and look at their recent investor report to see what we can learn about the company's current situation. All right, so really quickly, I just want to go over Disney's mission statement, which is to entertain, inform, and inspire people around the globe through unparalleled storytelling, reflecting on their iconic brands, creative minds, and innovative technologies to make them the world's premier entertainment company. Obviously, that's a whole lot of nothing, but I think it's important to understand what the company's goal is so we can judge them based against that goal. Here we can see that Disney has a number of subsidiaries and affiliates, and their business is broken down into three core segments: Disney Entertainment, ESPN, and Disney Parks, Experiences, and Products. As I scroll down, you'll see a number of companies that are owned by Disney. Some of them you might not be aware are owned by Disney, others you might have already known. But you can see that they encapsulate a wide range of different industries and different interest groups. And so Disney is really in almost every corner of entertainment in the American and world landscape. Moving over to the company's investor relation report, I first wanted to go over their recent business highlights because there's going to be a lot of lowlights coming, so I just wanted to show the things that are going well at Disney first. So starting off, their Avatar: Way of the Water is the third highest grossing film of all time, which is on track to be the largest ever electronic home release for Disney, at least domestically. They've also improved their direct-to-consumer operating income by $1 billion in just 3 quarters. They've had a new ride open up the Tron Light Cycle. They've announced that their park reservations will no longer be date-based, which gives customers much more flexibility to enjoy the park and to visit when they want to. They've also had the best entertainment channel in ABC for the 4th consecutive year, and the NBA playoffs were the most watched on ESPN since 2019. So even the company's legacy brands are showing some improvement, but as we'll go over in a little bit, there is a lot of negative to talk about as well. But before we dive into each individual segment, I did want to show off this drivers of growth and value creation page because I think it's important to know how Disney thinks it's going to grow in the future. So its 3 main sources of future growth that it expects is its studios, its park experiences, and its streaming. So going over its general media numbers, its linear networks have seen their operating income decline versus the prior year by $580 million. This is the result of lower affiliate revenue, but also higher production costs, including their NBA and Formula One agreements that they've recently made. Disney's direct-to-consumer branch, which is their streaming branches, saw revenue increase by 9%, and their operating loss decreased to $550 million against the prior quarter, due mostly to improved results at Disney+, a higher operating income at Hulu, and a lower loss at ESPN+. Domestically, Disney saw a 13% decrease in their operating income at their parks and experiences, and that was partially due to their results at domestic parks and their Disney Vacation Club, and was offset slightly by the increased success of their Disney cruise lines. The company believes that a crunch on consumer budgets as well as higher inflation is most likely to blame for this decrease in turnout in the United States. Internationally, Disney did see operating revenue growth, largely due to China's economy still continuing to reopen and normalize after their long COVID lockdowns. We can see that their growth was primarily driven by their Shanghai Disney Resort as well as their Hong Kong Disneyland Resort. And finally, at the bottom, we can see a decrease in operating income against the prior year in their merchandise and consumer products section, mostly due to lower licensing revenue on certain franchises of theirs. Now, getting a little more in-depth into Disney's streaming, we can see that Disney Plus Domestic is actually struggling a little bit with keeping subscribers as they lost 0.3 million versus the prior quarter, but their average revenue per user has increased a little bit. Disney Plus International has seen much more success, adding 1.1 million users against the prior quarter and increasing their average revenue by 8 cents per user. Hulu's total subscribers increased by 0.1 million, and their standard video on demand average revenue increased by 66 cents per user, although their live TV plus standard video on demand decreased by 52 cents per user. Their increase in SVOD only is much more important, though. As we can see on the left, their SVOD only makes up the vast majority of Hulu subscribers. Where Disney is struggling most, though, is in their ESPN Plus division, where they lost 0.1 million subscribers and their average revenue per user decreased by 19 cents per user. ESPN has recently become a very struggling brand for the company, and it's one of the brands that I think we should watch to see if Disney is able to turn it around and start creating more money with this iconic sports brand. Moving over to recent headlines, I do want to bring up the giant elephant in the room, which is Disney fighting with Florida and its governor, Ron DeSantis. This headline currently focuses on a recent change in their lawsuit over free speech claims. I don't want to get political with this because this is a very political hot topic, but essentially Disney and the state of Florida are feuding back and forth over what occurred in 2022 and 2023. And in my opinion, it's bad for both parties. It makes the Florida government look kind of medieval, and it makes Disney look like they think they can control politics. And so I think whatever side of the political spectrum you fall on, you're going to see an issue with this. And I think it just hurts Florida's brand and Disney's brand at the same time. So in my opinion, I just want to see this get resolved as soon as possible if I'm a Disney shareholder, because it's just negative news after negative news. In a recent deal in August, ESPN struck a $1.5 billion deal with Penn Entertainment to get into the sports betting industry. I think a lot of people see this as a plus because it should bring in a decent bit of revenue for ESPN. But I do think this hides significant issues with ESPN. Disney has been struggling to monetize the brand and to turn ESPN around into the cash cow that it used to be for the company, and I think this is their final resort at doing so. For many years, Disney came out and said that they were against any sort of sports betting with their ESPN brand, and they really missed the opportunity when the industry was young because they felt that they didn't need to do that and they didn't want to do that. Now, whether they did the U-turn because sports betting is now seen as an acceptable form of entertainment, a family-friendly form of entertainment, and not just for gambling addicts, or if they're doing this because the ESPN brand is really struggling and they desperately need the revenue, I can only speculate, but I think there is some solid revenue potential here, and we'll have to see just how much market share ESPN can gain in the future. But all is not well for Disney at the box office. This headline shows that Disney's CEO Bob Iger is very exhausted and overwhelmed after multiple box office flops. If we scroll down, we see that Bob Iger came out of retirement to save Disney as a company, as he was recently the CEO and then left. But since his return, Disney's lost an estimated $900 million due to underperforming movies this year. There are several reasons for these disappointments in the box office, including hefty budgets that just are too high to be recuperated, as well as movies that are just getting mixed reviews. They're not great, they're not super entertaining to most people, and so that discourages audiences from coming to see the movie in the theater. What's worse is, as we saw earlier, Disney Plus is also losing subscribers, at least in the United States, and so that shows that there's also a group of people that are not just not going to the movie theater, they're also just not interested in Disney in general anymore. And so I think we're seeing a major slide in Disney's brand strength currently. It's nothing that I think is going to ruin their 100 years of power over the entertainment industry, but it is significant in that the last few years Disney has struggled to put out movies that people find entertaining, especially since that is their main goal as a company. I saw this great article from Bloomberg that came out recently. It's titled, "Has Bob Iger Lost the Magic?" It's locked behind a paywall and we don't do that, but I just really like the photo, and I think it shows that more and more people and larger outlets are starting to talk about how Disney is really starting to struggle. And finally, some news today about Disney World raising their prices for annual passes and parking. I think this goes hand in fist with the issues around inflation and around their declining foot traffic at their parks. I think this is going to be a trend that we continue to see in most Disney parks and theme parks. And unfortunately, I think they're doing it at the wrong time when most consumers are starting to feel very strapped for cash and they're much more likely to not pay for these extravagant experiences. So that was our overview of Disney as a company and some of their recent news headlines and struggles. Let's get into the numbers and see if financially this investment makes sense. Disney's revenues have been increasing nicely over time, which is good to see, growing at over 10% per year with just a small blip during the COVID lockdowns in 2020 and 2021. EBITDA has seen a much greater dip following the COVID lockdowns, but we can see that it was falling even into 2018 and 2019 before 2020 caused a major crash. Recently, the company has been recovering slightly, but it is still not at its pre-COVID levels. Annual operating earnings again look even worse, with a negative number in 2020 and very little improvement following that, getting positive but staying around $1 to $2 per share since 2020. Compare that to $6 and $8 per share in 2019 and 2018 respectively, and we see that Disney still is struggling to get back to its former glory. Gross margins dipped from about 45% down to the low and mid 30s, and they've remained steady there and don't appear to be improving. Operating margins have fallen by more than half, from 17% in 2019 down to 8% in the trailing 12 months. There has been some improvement as they hit a low of 5% in 2021, but we would like to see that number come way higher. Disney's return on assets are also abysmal, sitting at about 1% versus 12% and 5% before the pandemic. In 2018, the company issued a ton of new shares, adding almost 4 million new shares outstanding. Since then, they've continued to add shares, but at a much slower pace. But I think this is a trend that Disney is going to continue with for the near future as they continue to struggle to make money. Disney's cash and short-term investments have grown significantly following the pandemic, which is very good to see. The company is still holding on to a significant portion of its cash, and I hope they continue to do that in order to use it in times when they desperately need it. Long-term debt did increase significantly between 2018 and 2020, but since then, Disney has been paying down its long-term debt. I do not mind the fact that they've taken out debt because we are seeing that they are paying it off over time. Although as the company struggles, I do expect to see their debt payments going down and to see more of that debt to be extended into the future rather than just being taken off the balance sheet entirely. And as Disney extends that debt, we are going to see their interest expenses continue to get more and more negative. Even though their highest amount of long-term debt was in 2020, we can see that in the trailing 12 months is when the company has spent the most money on its debt. That is because of this massive rise in interest rates, and the more debt that Disney has to extend out into the future, the more debt they're going to take out at higher interest rates, which means higher interest expenses and lower operating earnings. The company's levered free cash flow has been fairly stable even throughout 2020 and 2021. So I think that is one of the few plus sides we can see so far. But on a per share basis, their free cash flow looks ugly. Remember, Disney issued a ton of new shares in 2018, and that is why these numbers have dropped so dramatically. If you had bought Disney in 2018, you would have bought $6.56 of annual free cash flow. But today, your same stock is only worth $1.56 per share of free cash flow due to this massive dilution. If anything, I think this graph is just an excellent reminder that when companies dilute shares, it does have a significant effect on how much you as a shareholder gain from the company. Disney did pay a dividend up through 2019, but the company did cut that dividend following lockdowns in order to save money. I think that was the right move, and I am expecting the company to continue to not pay a dividend at least for the next year or two because they do have plenty of problems to figure out, and I think paying free money to shareholders is the wrong way to solve those problems. So moving over to the value chart, we can see that Disney is exceptionally overvalued currently. And that is to be expected with such a large brand as Disney. I'm sure most investors and most people on Wall Street expect this company to be able to turn around. I do too. And so this massive dip in earnings is viewed as only temporary, and people aren't going to drive the price all the way down to where a 15 PE would be for these rough few years. Currently, the fair price is sitting at $18.45, which would just be ridiculous. I would be buying hand over fist if the company was even twice that price. But this is an excellent example on how a company's stock price is heavily dependent on its future growth. We can see that its projected compound annual growth rate for the next 5 years is almost 20%. So analysts expect Disney to be able to get back to its profitability that it had before the pandemic fairly soon. If for some reason the company is not able to do that, I would expect a massive crash in Disney's price because, again, the stock price is largely predicated on this turnaround and the turnaround occurring relatively soon. So what I like about Disney is that it's an iconic brand known worldwide. Its theme parks are remarkably resilient over time and across generations. I do think that there will be ups and downs as far as park attendance just due to the consumer situation on having money or not having money. But I see people that are 4 years old and people that are 40 years old continue to enjoy their theme parks. And so I think they kind of have this timelessness that is a very good quality to have. And there's tons of diversity in Disney's businesses. If they're all underperforming like they are currently, we're going to see the company really struggle. But I think that underperformance at this company is also probably a precursor to outperformance. And I think it's a pretty rare situation when every component of this company is underperforming at the same time. But what I do not like is the bad PR that's been going on for the better part of 3 years. Disney has had just bad headline after bad headline, and I think that is set to continue as more and more people see this company struggle. And as we know, bad headlines tend to lead to lower prices in the stock market. And so I think that it's just kind of a touchy time to be buying the stock because there's just so much bad news coming out. Disney is also still struggling to normalize following 2020, and I see that struggle continuing to occur into the near future. Many of their struggles are not directly their fault, especially when it relates to their theme parks, but we can also point to Disney Plus struggling domestically, as well as many of their box office flops, and say that Disney is also struggling itself, so we can't just blame all of these issues on 2020. And finally, several of their main profit drivers seem to be slowing down. As we saw in the headlines, Disney park attendance is starting to fall and they're starting to raise prices as a result. We've also seen that their box office has struggled a lot lately, and several of their movies have not made a profit. And on top of that, their streaming services are generally starting to make more money, but it's not a very significant improvement in order to make up for the other struggles elsewhere in the company. So for me personally, I think Disney is a stock that I want to keep on a watch list, and I'm going to hope that it continues to fall down into the $60 or $70 range before I think about investing in this company. There are just too many unknowns, and I think the issues that Disney are also coming at a time where there's probably going to be future issues in the U.S. economy, and that does not line up well for a company that relies heavily on consumer discretionary spending. 15 or 20 years down the line, I think today is still a decent day to buy Disney, but I personally believe that there are better opportunities out there, and I would rather wait to see that Disney can either continue to turn around the company or wait for an overreaction from Wall Street as Disney continues to struggle before I enter this company. So those are my thoughts. What are yours? Do you think Disney is a good investment right now, or would you rather wait on the sidelines like I am? One last time before you go, please leave a like, a comment, and subscribe to the channel. It means a ton to me. And with that, I hope you guys have a great day.